Hi, everybody. This is Alan Elman, the Blue Collar Investor, and welcome to this video titled 5-Day Cash Secured Puts Trades Yielding an Annualized 33% Return. I'm going to use a real-life example with Apple Inc. that trades on the NASDAQ exchange under the ticker symbol AAPL. You're already familiar with Apple Computer. So these are trades that I've been using now for the last month or two, as interest rates in 2020 were at zero. So looking for a way to generate income using very low risk option selling strategies. So when we use cash secured puts to generate cash flow, we always start by selecting elite performing stocks. That will be useful because these are the ones that have the best chance of not declining in price. No guarantees, but if we select elite performers from fundamental, technical, and common sense perspectives, the odds are a bit in our favor that they won't go down in price. Once we have selected the underlying security, we don't have to purchase them, but those will represent the underlyings for then selling out of the money cash secured puts. So out of the money for a put is lower in price than the current market value of the stock. Now, our brokers will require us to put a certain amount of cash into our brokerage accounts to cover the trade should those put options be exercised and those shares be put to us. We have to be able to pay for them. So the formula that the broker will require is the put strike. Remember, it's below the current market value of the stock, minus the put premium, times 100, and then times the number of contracts. So for every put sale that we make, we have to follow that formula and put that amount of cash into our brokerage account. Now, in general terms, put sellers are looking to generate cash flow. They don't necessarily want to be share owners, but you still must be willing to accept those shares should they be put to us. These are American style options. As a put seller, we have contract obligations, and the put owners have rights, and they have the right to put their shares to us at the strike price at any time. Now, early exercise is extremely rare, but still we have to be prepared to accept exercise of the options should those options be exercised. Okay, if that happens and the shares are in fact put to us, we have a couple of choices. We can just keep the shares, in our long-term buy and hold portfolios. We could sell them at either at a profit or a loss. We could write covered calls using the PCP strategy, put, call, put. So we're integrating two option selling strategies into one multi-tiered option selling strategy where we first sell out of the money cash secured puts, and then write covered calls if those options are in fact exercised. Now we can also buy back the option prior to exercise, that's buy to close on our broker forms, to avoid exercise and assignment. So there are a myriad of things that we could do to manage our trades, and we must be prepared not only to take advantage of trades that are going in our favor, but also to mitigate when trades do turn against us. And that will happen in a certain percentage of our trades. Here's the strategy proposal now to generate a significant weekly and annualized return in a very low risk manner, selling out of the money cash secured puts. And let me add this, deep out of the money cash secured puts. So we're going to start our trades on Monday and end them on Friday. So these are 5-day deep out of the money puts, and we're going to target an annualized return without exit strategies of 18 to 20%. That calculates to 0.4% per week. That's a guideline. Doesn't have to be precisely 0.4%, but somewhere in that neighborhood. And of course, these numbers can be adjusted based on your strategy goals and personal risk tolerance. Now, we're always going to avoid the weeks of earnings reports. So if we're using the same security over a period of a year when we're doing our annualized calculations, we will be multiplying this number by 48, not 52, because there were going to be 4 earnings reports per year. Now we're going to, this is important, folks, we're going to select strikes with deltas less than 0.10% or representing less than a 10% chance of exercise. That's why we're going deep out of the money. Now we want to take advantage of exit strategy opportunities to increase returns even higher. Now there won't always be exit strategy opportunities that will present themselves during that 5-day period. But when they do, we must be prepared to take advantage of them, as you will see in this video. Now, if the share price turns against us and moves down below the put strike, meaning that if we take no action, there will be exercise at the strike price after expiration, we can always buy back the put. Now, that may represent a gain or a loss, but it's one way to mitigate against having those shares put to us, and perhaps even having the shares decline in value even more at that point in time. We can also roll the put, buy back the current week, and then sell the next week put to the following week. We can allow assignment and keep the stock for the long term. Some put sellers use selling cash secured puts to buy a stock at a discount instead of setting a limit order. We can also allow assignment and sell the stock. Once again, could be at a gain or a loss. We can allow assignment, have the shares put to us, and then write a covered call in the money, at the money, or out of the money, continuing the process of profit generation from option premium. Now, if the price of the stock declines but remains above the put strike, we don't really have to do anything at all. Just let the option expire worthless, and then the following Monday, sell some more cash secured puts. Now let's look at the brighter side of things. What if the share price moves up? That's a positive for us. Well, what happens is the put value will decline because puts, as far as their pricing is concerned, is inversely related to share price movement. So if the price of the stock moves up, the put value will go down. So that will give us an opportunity to buy back that put at a lower price than we actually generated when we sold it. And then what we can do is we could roll that put up to a higher strike, generating additional time value premium, as long as the put strike still retains deltas less than 0.10. Okay, because that means that there's a 90% chance that that strike will not expire in the money. And that's really what we're looking for with this particular strategy, for that strike to expire worthless. That's why we're stressing delta in this particular case, when I rarely stress delta with other approaches to option selling. So here's a real life example taken with Apple Computer, which is taken actually right from my portfolio. And it's a 5-day trade ranging from September 21st to the 25th, 2020. So when I entered the trade on the 21st, Monday, Apple was trading at 106.60. So I sold the deep out of the money 96.25. Notice it's trading $10 lower than current market value, and I generated 38 cents per share. Now the next day, Apple Computer went up in price, thereby moving the put value down, and I was able to close those 5 contracts. That's what I used here, 5 contracts, at 6 cents a share. Immediately, I sold the 101.25. So notice I rolled up from 96.25, $5 higher, to 101.25 and generated 24 cents a share. Now that strike still had a delta under 0.10. 2 days later, I was able to close that 101.25 put at 16 cents. The reason for that, I did that, was because I was able to roll up to the 103.75 strike and generated a higher premium of 34 cents, still retaining a delta of 0.10 or minus 0.10 for a put. Finally, on Friday, I closed the 5 contracts because Apple price was going higher, and I was able to close all 5 contracts at 2 cents or $10 for the 5 contracts. I did this as a precaution in case at the end of the day on Friday, Apple dived in price below the put strike. Now, that actually didn't happen, but it gave me that kind of protection. So for $10, I closed all 5 contracts. So at that point in time, I didn't own Apple, at least not in this portfolio, and I had no contract obligation. I was done. Let's have a look at the initial trade structuring on Monday, September 21st, using the BCI put calculator. You could see on the blue cells now on the top of the spreadsheet that Apple was trading at 106.60 and the 96.25 deep out of the money put strike was sold at 38 cents. And that generated a 0.40% initial 5-day return, which is exactly what we're looking for. It's not always going to come out exact. It happened to come out exact this particular day. The week before came out a little bit less, like 0.38, but whatever, it had a delta of under 0.10, so it met our system criteria. So far, so good with the initial structuring of our trade. Now, here's the broker's statement from the 21st, Monday, to the 24th, which was on Thursday. We have a separate slide for Friday. So on the 21st over here, you can see that we sold the 96.25 put, and we got 38 cents a share. Now, the next day, which was Tuesday, the 22nd, we were able to buy to close those 5 contracts at 6 cents a share. And then I immediately sold that 101.25 strike on the 22nd for 24 cents. Now let's move on to Thursday, where I was able to close the 101.25 strike at 16 cents and actually rolled that up and generated 34 cents for the 103.75. So notice that each time I rolled, I ended up with an option credit, still retaining our options at a delta of minus 0.10, meaning there was only a 10% chance, a less than a 10% chance of exercise when the contracts expired. Now, here are our 4-day results before I go into the final trade on Friday. I'm going to use a cost basis of 103.41 because that represented the highest amount of cash for the last strike sold using the put strike minus the put premium times 100 times 5 contracts. So that came to a cash requirement of $51,705. That's how much cash I had to set aside in my brokerage account to secure the final put trades for 5 contracts. Now, my option credits for those 4 days were 38 cents, 24 cents, and 34 cents. Now, the cost to close the first 2 of these strikes was 6 cents and 16 cents. And that resulted in a net per share profit of 74 cents. That's taking in the credits and the debits. And that represented a profit of $370 for the 5 contracts. Now, on the cost basis of $51,705, that represented a 4-day return of 0.72%. So if we took no action on Friday, that would annualize out to 34% over a 48-week period. Remember, 4 weeks, we're not selling options on that same security. Now, if we, in those 4 weeks, use the different security, we could generate additional premium. But we're just making the hypothetical assumption now that we're going to use the same underlying for the whole year. That rarely will happen because a lot of these stocks will start falling out of favor. But that said, we're going to use a 48-week return, which again was a 34%. Very significant annualized return, given that interest rates at the time I'm executing these trades were around 0. So now the final day, or Friday, the 25th, what I did was I took this action because Apple was going up in price. So I was able to close that last 103.75 strike at 2 cents, $10 for the 5 contracts. Now I did that just in case Apple took a dive towards the end of that last trading day. I figured for $10, what the heck? Let me just secure my profit and not have to worry about a decline. The volatility in the market at the beginning and the end of trading days was quite large, so I decided just for $10 not to take that risk. So that took $10 of cash away from my option net credit, and that resulted in a 0.70%. Remember, we started at 0.4 for the 5 days, and that annualized out to 33.4% over a 48-week time frame. So that's just goes to show you how you could craft these strategies to meet whatever your goals are. And particularly in a low interest rate environment, this is almost like hitting the lottery. So let's summarize now. Selling deep out of the money cash secured puts can generate significant weekly and annualized returns. We still have to have our exit strategies in place for both scenarios, where the trade turns against us and if the trade turns out to cooperate with us, which means share price increasing in value as it did this particular week. Now, factoring in delta and initial time value return goals will assist with the strategy structuring. In this case, our weekly time value return goal was 0.4%. It's a guideline, somewhere in that neighborhood, with a delta of less than 0.10. So those were the guidelines in structuring our trades. Now, adding in exit strategies will elevate returns for trades that are going in our favor and mitigate losses when the trades turn against us. So we have to be prepared both ways. Now, for additional products, educational products on selling cash secured puts, you go into the bluecollarinvestor.com/store, and you see on the top left there, we have online video lessons with downloadable workbooks. On the bottom left, we have spreadsheets and calculators. On the bottom right, we have books. We also have them available in ebook format. Now, the best book for selling cash secured puts is my only book on cash secured puts, which is #1 on Amazon for this topic since it was published. Alan Ellman Selling Cash Secured Puts, so you can find that on the website where I showed you. The online video program is a seminar, a live seminar I did. It's 2 discs along with a downloadable workbook in the video section of the store. And also the best calculator and our latest, the Elite Plus calculator, which has a combination of covered call writing and selling cash secured puts. So you could use this calculator for both strategies, and it will give you the calculations not only for each individual position, but for your entire portfolio as well. So that's it, ladies and gentlemen, for this video, 5-day cash secured puts trade yielding an annualized 33% return. Real life taken right from my portfolio. I'm actually making this video on the Saturday after the 5 days you saw in this particular video. We used a real life example with Apple Computer. Folks, I hope you enjoyed this video. I hope it gives you some food for thought and how to put cash in your pocket. Thank you so much for taking the time to listen to this video. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.